Good morning, guys. It is Monday, May 6th, 2024. This is Bathrobe Business. I'm Georgi Oganov. I got the coffee and I got the news. I was off on Friday. As I told you, there wasn't going to be a video on Friday, but I'm coming back to the major news story of the day, and that is job growth. So I was actually very surprised and shocked. On Thursday, I reported to you guys the ADP numbers, which traditionally, I shouldn't say traditionally, but for the last 3-4 months, have been underestimates on economic growth. But now ADP numbers were an overestimate. So according to the Labor Department, we only got 175,000 jobs in April, which is much less than expected of the 200,000 that were anticipated. In addition, unemployment actually rose to 3.9% once again. This is a little troubling because when you also compare that to the Jolts report, and the Jolts report, it stands for jobs, overturns, layovers. It's an acronym for something. Actually, give me 2 seconds. What does Jolts report stand for? The Jolts report is job openings and labor turnover survey. So it's essentially measuring how many openings employers have, how many people are quitting jobs. And the Jolts report is actually showing that the job growth is actually slowing as well. So it fell to a 3-year low in March. So we're talking about going back to 2021 numbers, where job openings have decreased drastically. Less people are leaving their jobs. Now, I don't think this is as strong of an indicator as a lot of people in the market are thinking, because we still had major growth in wages in the last jobs report, and this isn't the first time we've had 3.9% unemployment in recent months, only to have it drop again in subsequent reports. So this doesn't mean that we're actually facing a recession now, but I think it is the first sign of a weakening labor market, which is good for inflation. I think there is still more to this story, and we'll see what next month's payroll numbers have to show. But I think this is the first time we're seeing some sort of ease in inflation on the horizon. That's the one major story I'm going to talk about. The other major story I'm going to talk about is cars right now. And because I think this cars is actually going to open up to a bigger point I would like to make. So, cars. U.S. automakers like GM are rapidly losing market share in China. This isn't new information, right? We've talked about how Tesla is losing out in China and how their local brands are becoming stronger and stronger, not just domestically within China, but abroad as well. But I think this GM story really starts to illustrate something even bigger. So, GM lost about 106 million during the first quarter in China. So, this is for 2024. This is the third largest quarterly loss in the region in at least 15 years. But what's also pretty amazing is how much market share that GM has been losing over the last decade. So in 2012, it was about 1.5 billion in revenue that they were making in China, with a market share of about 14.6% of the car market within China. That was pretty consistent throughout the 2010s. And it really started to drop around 2018, where they also kind of more or less hit the peak. I should say the peak was actually in 2015 with 2.1 billion and 14.9% market share. But 2018 is when the peak started to drop. So now, as of 2023, they only have 446 million in revenue and only 8.6% market share, as China's domestic manufacturing just grows and swells and is now consuming internationally as well. As I told you guys, I was in Peru last month. I guess not even a full month. It was 2 weeks ago. And I saw Chinese cars everywhere. At least half of my Ubers were Chinese cars. I saw Chinese dealerships. They are growing not just domestically within China, but internationally as well. But I think this illustrates a larger point. I think this underlying this shows an underlying weakness in the American economy, and I would like to recommend you guys check out a podcast called Multipolarity on YouTube. It's a couple economists and geopoliticians on there that host a podcast, and they talk about economics in a manner similar to Peter Zion. I do still listen to Peter Zion. I do like Peter Zion. I think he makes some interesting points. I think he is a little bit biased, a bit of an old school neocon. Maybe neo-lib. I don't know how you would classify him, but I think he's very traditional, American-oriented, American exceptionalist kind of opinion, whereas I think multipolarity kind of takes the opposite side. And when you combine those two, you kind of get more of a balanced approach. I think Zion is spot on about his demographics, but I think he is too bearish on China and too bullish on the U.S. But an interesting point brought up in that podcast was how do we really have productivity gains in the economy if we don't have a manufacturing sector, and why that's important. So traditionally, gains in productivity are one of the best indicators of GDP growth and best indicator of economic innovation, of technological innovation, etc. So what does that mean? Essentially, if you are producing a product and you have 10 employees, and in the first year you were producing $100 million of product, and then in the second year you were producing $120 million in product, and you had no additional staff come in, that means you had a productivity gain. So your people, your company, has discovered a way of producing more stuff for the same amount of money, or maybe even less money. That's a gain in productivity, and that's a powerful economic measure because that's what is one of the primary drivers of GDP and growth within the economy. Now, United States has not had a real economic, I shouldn't say economic. The United States has not had actual productivity growth that has been moved by manufacturing in a long time, right? Because manufacturing has left the United States a long time ago. We've become mainly a service sector economy. So, can you really have productivity gains that are not based in manufacturing? Can you really have productivity gains? Sorry, I'm kind of stumbling because this is stream of consciousness, but what I'm trying to make the point is, can you really have gains in productivity if you don't have manufacturing? Because if you have a service industry, if you're a bartender, if you're a waitress, or even if you're a financial service industry, can you really have innovation and growth if all you're doing is doing transactions on a day-to-day basis? You really can't, because there's only so many things you can do more productively. So where does the growth in GDP happen? Well, the growth in GDP happens often through inflation of assets and asset growth. So essentially, you're building in inflation into the economy in order to show higher GDP numbers. Now, the why I want to illustrate this is last month I reported really low GDP numbers. But if you actually delve into the details, the reason we had low GDP numbers was because China had incredibly high GDP numbers and incredibly high trade deficit with China. They were outputting more than we were, and we were buying more of their products. So this is what I'd like to illustrate. Without strengthening our economics in manufacturing, we can't have real GDP growth. And as this is a decline in GM, which is one of the strongest manufacturing companies in the United States, we're going to see lower growth in GDP. But any growth that does happen is probably going to be the result of asset inflation and growth in assets like homes, stock market, etc. So why this is important is I think this is underlying a powerful weakness in the U.S. economy in the fact that we don't have actual manufacturing growth and innovations in productivity. So that's really the point I'm wanting to make. I hope that's not too abstract because I was kind of trying to explain a stream of consciousness. But the point is, I'm trying to say that with China's growth in manufacturing now in automotives, this is directly going to undercut U.S. GDP growth. And it's something that we need to worry about. And as we talk about reshoring and growth in the economy, we have to make sure that growth in the economy is coming through real productivity gains in things like manufacturing and not just asset inflation, which is what I think the majority of the economy has become, right? The cost of homes directly relates to this. As GDP has grown, the cost of home ownership has grown. The cost of financing any sort of asset, including like a car, has grown as well. That spurred GDP growth, but at what cost? It's just inflating the numbers. So that's the point I'm trying to illustrate here is this increase in Chinese manufacturing is directly impacting our shrinkage in GDP growth. And it's something we really need to focus on is on productivity gains directly in relation to manufacturing. That's pretty much it. That's all I have to say for today. It was just those two stories I wanted to cover because I think they have grander implications. I'll see you guys back here tomorrow. I hope you have a productive day, and I'll see you in the morning. Thanks.